Hello guys, welcome back to the channel. Today we're going to be looking at alternative inflation charts and basically why the reported inflation and reported consumer price index is definitely lower valued than you would think right now. So this is all talking about the money that you spend and how it's felt within your wallet, basically how much money you have, or how it's felt in investment terms. Just to go over it quickly, the consumer price index is valued at a bunch of things, so how much goods have increased in price over the year, and then they record this every year. And the figures can be based on basically everything you can buy. Mainly, this is to show how much everything is valued at and how much it's inflated in price since the year previously. So it's not technically real inflation because it's based on goods, and we'll get a bit into that on how that has changed over time, but it gives you a good idea of how much stuff has inflated in the cost of goods, basically. So this is a chart which you would normally see. This is the consumer price index chart. You would normally see this red and yellow line. So this is what has been reported for the past 20 years, I believe-ish. And as you can see here, we have the financial crash in 2008 and then in 2020. And subsequently, you see this massive increase right here. So this is based off the cost of goods going up. Now, what you see here is the red and yellow lines right down here, and these are the reported figures right now. However, this blue line is the SGS alternative, and it's from the 1990 based CPI. So one based on the pre-1990 official methodology for computing the consumer price index, and the other based on the methodology which was employed prior to 1980. As you can see here, there's a very stark difference between the two. The blue one is always reported higher, but they don't actually report it as much. But the red one is the normal number that they would report. Right here in 2023, or this would be kind of 2022, you can see it's up around 9% right there for the consumer price index. However, based on the methodology previously, it would have been around 15%. So a very, very high consumer price index there, basically meaning that goods across the board have increased by 15%, which means you're going to have to spend 15% more to get that. Now, one thing that you talk about is the inflation rate and how that factors into the salary of people. Normally, when you get a pay rise, it's not even as much as the inflation rate. So it may seem like a good thing that you are getting a pay rise, but it's nowhere near what the inflation rate is. Now, you might be thinking what the difference between these two numbers are. And the main difference is in the red line, they can interchange the goods. So say 1 year coffee or maybe milk or bread has increased quite a lot in price. You could actually take that out because it was affecting, the consumer price index too much, and you would have a higher figure recorded. Normally, they don't really want to produce this blue line because nobody really wants to see a very, very high consumer price index or very high inflation rates on a number of goods. So I believe that this blue line one was actually based on a methodology of not changing it, and it was going based off certain consumer goods. However, the red one, I believe that they do interchange the goods to kind of skew the figures in their favor. And all that to say, I would say that this blue line is probably the more real line of inflation that you would have. It's just this red line is what they report. So right now, we're looking at an inflation rate of around 8% or 7 to 8%, even though it's recorded at around 4% right now. And when it comes back to investing, as we always say, you have to beat inflation, and then anything on top of that would be considered as your profit for the year or the last 5 years, depending on how you're recording it. But it's very hard to beat an inflation rate like 15%. So many people, even it would be hard to beat an inflation rate of 9% in a normal market, excluding the fact that the market jumped vastly back in 2022 and 2021. As you can see here, over this 10-year, let's go to 5-year chart. You can see back here in 2019, it's down at around 2,900, and it's all the way up to 5,400 or 5,500, which is an annual return on the last 5 years of 13.24%. Now, that doesn't necessarily mean that everything is going good if the markets are still continuing to go up, because it's not felt at a consumer level. The market might be up, but that's on a corporation level. So a lot of corporations and companies have increased profits for the year, stuff like this, but it's not felt on a lower level of the employees or the consumers around the globe. This is why when they talk about on the news a lot of markets being up, it doesn't necessarily factor in the fact that pay rises haven't gone up, or the cost of living has also gone up as well, but the pay is not kind of following that cost of living increasing. So it's all to do with this inflation and consumer price index. Now, I'm not in the US, but as it follows in history, it's basically whatever the US has. Normally, you can equate that to a lot of the world. So if something inflates in the US, you're going to have inflation around the world, depending on the situation that you're in. And mostly it would be in places like, obviously, North America, but in Europe as well. So if you want to check out this chart, it's Shadow Stats. It just displays a lot of alternative data that is kind of hidden statistics for a macro economy, not necessarily looking at the micro side of it. Here we have the M2 money supply. So if you don't know what this is, it is a measure of basically how much money is created or printed over the year. And as you can see here, from around 2018, it was around 13 billion, but that would actually be in trillion because it's 13,000 billion. So we got 13.4, 13.5 trillion, and it shoots all the way up, as we can see here, to around 21.7 trillion. So that's nearly a 80% increase. So this actually has an effect on the value of your money. If you create more money, it's going to devalue that money by that percentage. What does that mean in the pocket of the users of the money? It basically means that whatever money you had in 2018 has been devalued by around 70 to 80% by March of 2022. That's on a global currency scale, and I'm sure that there's different statistics for different countries, but mainly, as I said, a lot of them follow the US. So the main portion of this video is to kind of give you an idea of how your money is devaluing and why it should be crucial and why you invest your money into assets rather than just saving it in the bank. As we always say, dollar cost averaging is going to be the best way. But if we go back to here and we say, this goes up to around 15% on the consumer price index, I'm not necessarily saying that this is the actual rate of inflation, but I think it's a better estimate of how much things have increased in price. And then on the flip side, you see how much your currency has devalued. So if we put it into investing terms, you basically have to catch up with how much this is devalued. So in the past 5 years, you would have had to basically increase the amount of money that you made by a factor of around 70%, which isn't necessarily too hard because the market is still going up. As we said, it's an average rate return of around 13.24. That's only if you're invested. A lot of people don't invest, they save their money, and it's been devalued by a certain amount. If you had your money in the market from 2018, if we go back to 10 years, let's just see here, it's around 2,600, and it goes all the way up to 5,475. Which, as you see, average rate of return is 10.86. This would basically mean that your money would have doubled by the time that it got all the way up there if it was in an S&P mutual fund or ETF, something like that. So by doing that, you would have preserved your wealth and you would have outbeat this M2 money supply by around 10 to 15% if you had it in the market. As I said, it's crucial that we have investments in the market because of the fact that if we are saving it, it's basically losing out to inflation. And this is based mainly on the supply of money. It's being devalued by that amount. As you can see, you can have drop-offs, which we see here, which means that your money is actually increasing in value, but it doesn't look to be dropping off too much down to the 2018 levels anytime soon. So what assets can you use to hedge against this inflation? Well, one of them would be gold. Another one would be cryptocurrency. Bitcoin has been very good as a hedge against inflation, and gold has also been a great hedge against inflation. If we're going to base it off like 2018 figures, as we saw back here, you would look here and you would say it's around 45,000 and it's come all the way up to around 76. So that would have hedged against inflation quite nicely as comparative to just saving it in a bank or something like that. Bitcoin and a lot of cryptocurrencies have obviously done better to hedge against inflation, but if you're in an older age and the risk factor is just not there, then gold is a better opportunity and you don't want to get into cryptocurrency. That's completely fine if you don't understand kind of what asset you're getting into. All that to say is there's a lot of information out there on inflation and how it's not recorded properly, and basically why you should invest in assets to hedge against this inflation and preserve some of the wealth that you've built up over time. So if you're saving money for something, I would say it's way better to have it in an investment. I personally would go for the S&P 500 or a global mutual or ETF and dollar cost average it out over time. So hopefully you guys enjoyed the video. If you did, leave a comment on your thoughts and make sure you like the video and subscribe for more content like this.